Professor Rex here. This week I added timestamp links in the description of the video in case you want to just jump to the list of stocks we bought this week, or the list of our best performers, or any other section of the video. Another thing I added this week is a slide about our best performing stocks from the time we bought them, as well as best performing stocks this week. An interesting thing to be aware of going on now: publicly traded stocks, which comprise this portfolio, are required to release their balance sheets, income statement, and statement of cash flows every quarter, and we are at the time of the calendar now when most companies are releasing these financial statements. So expect our list of best stocks to buy to change more frequently. So if you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts that I teach in class to pick stocks, because it grabs the attention of my students and gets them engaged. To show them the accounting concepts in action, starting 2 years ago, each Monday I invest actual real-world money, the equivalent of $50 each month, into 10 dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. In 2022, the market didn't perform well, but in 2023, stocks took off. Currently, the portfolio's value is over $1,640. The portfolio's return has been 17.54% per year, which is higher than the S&P 500. Last year, the portfolio's return was 28.6%, which also beat the S&P 500. And in the preceding year, the portfolio once again beat the stock market. So why do we only invest in dividend-paying stocks in this portfolio? That's explained on the next slide. The first reason we stick with dividend-paying stocks is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.18% per year, but for non-dividend-paying stocks, average return has been negative. The study seems to be updated each year, so go check out the source link that I included at the bottom of the screen. Maybe more importantly, historically, dividend-paying stocks have less volatility than non-dividend-paying stocks. It's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors as a reward for investing in the company. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolio only invests in dividend-paying stocks that have increased their dividend recently. So why did we choose to invest only $12.50 per week, which is essentially the same as $25 per paycheck? Next slide explains that. So the main reason why we invest only $12.50 per week into the portfolio is because I wanted to show my accounting students that you don't need much money to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money because we can buy a part of a share. You don't have to buy a whole share. Originally, I invested $25 per paycheck, but found the process to be so fun that I split it up, and I now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation every year. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. The research we discuss in class is the same research I use for myself. And another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assume the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year of investing in this scenario, it is assumed that the person invested an additional 35 cents per week for a total of $12.09 instead of the original $11.74. This slide shows our best performing stocks in the Classroom portfolio based on when they were initially purchased. 4 stocks have more than doubled, and they are Lam Research, Broadcom, F&G Annuities, and Evercore. Repositrac and KLA 10 Core are not far behind. 2 stocks have been sold, those being F&G and Repositrac. Also remember that total return includes both the dividends that the company has paid as well as the increase in the stock price. Now let's turn our attention to the strategy column on your screen, specifically the category called dividend growth stocks. 90% of our investments made in this portfolio were made in these stocks, which means they are high quality stocks with a great track record of increasing the dividend payouts to investors. The other 10% of investments so far have been invested in smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown that they historically beat the market averages by a significant amount. And this slide shows the best performing stocks this week, ranging from 11.1% to over 8.3%. Several are computer chip related companies. Applied Materials, KLA 10 Core, and Lam Research all make the equipment that create computer chips. And Broadcom is a company that makes computer chips. So Broadcom would be buying equipment from those other companies in order to be able to make their computer chips. And Travelers Insurance, the last one on the right, released their quarterly results this week. The company's financial statements showed that the Travelers had record quarterly net income per diluted share, and the company's return on equity was 29%. On the day that their financial statements were released, the stock jumped 6.7%. Now, here are the stocks we purchased for the portfolio this week. Remember, we're splitting $12.50 per week between 10 stocks, which means we are buying fractional shares in our Fidelity brokerage account. This table includes their industry, how undervalued they are, according to our research, their risk rating, quality grade, and dividend yield. Remember, all of these stocks pay a dividend and have recently increased their dividends, and our methodology here indicates that they are likely to continue to raise dividends. Therefore, this is a dividend growth strategy. New to the list of this week are American Express and Evergy, and electric utility. The most undervalued appear to be EOG Resources, an energy company, and Pepsi. And the lowest risk companies compared to other stocks are McDonald's, Pepsi, and that utility company Evergy. And utility companies tend to be some of the safest companies. One thing to note is we limit the allocation of any one stock if it comprises more than 4% of the portfolio. In other words, we don't want one stock to be making up and eventually something like 20 to 25% of the portfolio because it increases the portfolio's risk. So by limiting it, this results in a very diversified and therefore less volatile portfolio. Now, if we did not limit the investments made into a single company, our returns would likely be higher because we're always investing in the best of the best, but also more volatile because it's less diversified. Companies that would have made our list if we did not cap them to 4% of the portfolio include Microsoft, Charles Schwab, Fidelity National Information, and Comcast. Microsoft is probably currently my favorite of all of them. On this slide, I want to show the components of our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. The other 10% of our purchases so far have been invested in smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown they historically beat the market averages by a significant amount. All the stocks we bought this week qualify as high quality and are dividend growth stocks. Risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. This week's purchases with the best competitive advantages are American Express, Apple, Starbucks, and McDonald's. The next quality component attempts to evaluate companies' management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, also known as the quality or reliability of their reported earnings. And remember, earnings is just a fancy word for profits. The best management ratings for the companies we invested in this week are Humana, Apple, and Starbucks. And finally, the last quality component is financial health. The best of the companies we bought this week for financial health are Morgan Stanley, Apple, and McDonald's. Remember, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and higher yield are EOG Resources, NextEra Energy, Morgan Stanley, and Evergy, the utility company. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works. You can't have the best of all worlds. Companies that are already paying out the higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade, dividend growth potential, the companies in the best position to increase their dividends substantially are Humana, American Express, and Apple. The companies with the best combination of recent dividend increases and potential for future dividend increases are EOG Resources, the energy company, Humana, and American Express. So those are the companies we bought this week. We're trying other strategies too, using real stock portfolios. Besides this dividend growth strategy, we're also running the following portfolios: high yield dividend paying stocks, stocks with the best competitive advantages, also called moats, like the moat around a castle. Note that all stocks are eligible for this portfolio, both dividend paying and non-dividend paying stocks. And finally, we start a technology-focused portfolio investing in themes like artificial intelligence, big data, cloud computing, cybersecurity, and software as a service. And just for fun, I started a dividend growth strategy that invests in every sector, matching the S&P 500 sector weightings. This one is the biggest challenge because some sectors are more likely to pay dividends than others. So in the comments, let me know if you have any questions or if you want to know more about the other portfolios. Also, let me know what kind of other investing videos you'd like to see. And finally, here are the places you can reach me: YouTube, obviously, as well as Twitter, LinkedIn, and my website, beatthestockmarket.com. Have a great week.